All right, good afternoon everyone. Welcome to today's webinar. We're excited to have you join us to discuss the case for emerging markets and the recently launched Emerging Markets Fund from BetaShares and Legg, ASX code EMMG. Just before we begin, we'll just cover off with a little bit of housekeeping. So a reminder, information discussed today is of general nature only and does not take into account your particular investment objectives or financial situation. Of course, before making an investment decision, please ensure you read the product disclosure statement and speak with your financial advisor. Today's webinar will be recorded and the recording will be sent to you afterwards. And being a live webinar, we really encourage you to ask questions using the Q&A box in your GoToWebinar portal to ask some questions throughout the presentation, and we will answer them at the Q&A wrap-up at the end. I'm very pleased to introduce today's hosts, Andy Sowerby, Managing Director for Legg Australia and New Zealand, and BetaShares Chief Economist, David Bassanese. So under our partnership with Legg, 4 active ETFs have been launched to the ASX, including the most recent fund, the BetaShares Legg Emerging Markets Fund that we will be discussing today. We're seeing a lot of appetite for this exposure. So I will now pass over to David Bassanese, who will be discussing emerging markets, why an active approach works, and also the fund at the end. So over to you, David.
Thanks, Ellie, and thanks everyone for joining us for what's, I think, a pretty exciting development here at BetaShares to move more into the emerging market space here, and certainly extend our partnership with Legg, who, as you'll see, have got a very good actively managed fund in this area. What I'll be talking about today is really just the case for emerging markets, give you a bit of information about, you know, what are emerging markets. I'm sure many of you have heard the term, so just dig a bit more deeply into that. Why active? Why, you know, so at BetaShares we do have some active and we do have some passive funds, and we're as we've long said, we are passive, active, agnostic. It really does depend on the nature of the market, and as I'll sort of outline today, you know, there is a good case for active exposure within emerging markets, given the, I guess, inefficiency of the markets and the lack of, you know, a lot of publicly available information in a lot of areas. So, you know, those that do the time and do the research, you know, can generate some good returns there. So if we just go firstly in the first section, emerging markets. What is emerging markets? And essentially there's two elements to it. They're generally countries that have a lower level of economic development than developed markets. So per capita incomes are lower, and so that gives you a lot of upside potential, you know, to the extent these countries can continue to grow and move up the development scale. But they don't just need to be, certainly to be included in something like the global benchmark, which is the MSCI Emerging Market Index. Countries also need to have a reasonably developed financial system so that, you know, foreign investors can invest in their markets, can invest in the equity market. So there are some countries, you know, very poor countries around the world where it's still quite difficult to invest in those markets. So those are essentially the two criteria to be included in the emerging market index. And I guess, again, this is the benchmark index that a lot of active managers, such as Legg today, do benchmark themselves against. And so just some information on that. It's basically, if you look at it, it covers a wide range of countries. So the emerging market benchmark, you're looking at 5 different regions, 26 countries, over 1,000 potential companies. And essentially it does break down into 3 blocks, the way I look at it. So basically China these days is a big chunk of the market, about 1/3 of total MSCI exposure. Then there's another block, which is Korea and Taiwan, which together account for almost 1/4 of the index. So you are getting that sort of technology, manufacturing, emerging market exposure through Korea and Taiwan. And then another block of more, I guess, commodity-based countries such as Brazil, South Africa and Russia, which collectively account for about 15% of the index. So you're getting, obviously, China, a big one, and then a technology exposure through emerging Asia, and then a collection of more commodity-based countries as well. So that's really and then a whole bunch of other smaller countries, such as, Thailand, Mexico, Indonesia, all these sort of countries are also in there. So a lot of opportunities. So here's the case for. So first and foremost, it's where the people are. So if you think about it, we've got just over 7 billion population globally, and around about just over 80% of the global population is in what's defined as, using United Nations definitions here, less developed economies account for about 80% of global population. So that's pretty staggering statistic, really. That's the vast bulk of the global population still in markets that can have a lot of upside growth potential. The other element, not only is the population, they already have a big chunk of the population, but it's been growing quite rapidly. So this is the differences in population growth between advanced and emerging market and developing economies. Again, using IMF definitions here of these two groups, but there is a very close overlap with the emerging market area. And so, for example, in the 10 years to 2019, population growth in developed markets such as America, Europe, Japan, even in Australia, grew by 0.5% per year. And in emerging markets, it grew by 1.3%, so quite a noticeably stronger pace of growth. And over the next 5 years, the IMF are projecting growth in emerging markets of about 1.2% versus only 0.4% amongst emerging developed markets. So that strong, relatively strong population growth, a key driver of underlying growth in these regions. The other interesting element also is they have youth on their side. And so if you look at the skew of the emerging market population by age group, as you can see, there's actually almost half the population across developing economies are in the 0 to 24 year age group. So, relatively young population, and also relatively fewer in the elderly, over 65 group. So you've got the youth which will over the next few years move from in that youth area into the the working age area, 25 to 64 years, whereas in developed markets such as Australia, you've got still a bulk of people in that working age group, but they're moving into the retirement area over the next few years. So the demographics certainly favour emerging markets here with that youth. Not only is it young, but they'll be moving into that more productive part of the age range. And you can actually see the implications of that if you look at so-called dependency ratios. So this is the number of people aged 25 to 65 relative to those less than 25 and those above 65. So when you think about it, those 25 to 65, typically the workers of one's economy, and then they've got to help support those who are still in school, the youth, and those in retirement. So if you look at the moment, around about 2015, there was a similar ratio between developed and developing markets, about 1.9 workers for youth and those in retirement. And over the next few decades, really, in developed economies, that ratio is going to drop to 1.37. It will also drop in developed, in lesser developed economies, but certainly not as rapid. And again, if you think back to it, what we're seeing is a transition of youth into that working age population group amongst developing economies, and some current workers will move into retirement, but the movement of the youth into the working age range will help to largely offset that. And as I mentioned, so not only do they have strong population growth, it's where current the global population is, but the fact that living standards, GDP per capita is still relatively low means they do have a lot of catch-up potential. And so just to put some numbers on it, as at around 2019, the per capita GDP amongst developing economies was about $53,000 and amongst emerging and developing economies only around 13,000. So you're looking at 1/4 of the level of GDP per capita amongst developing markets vis-a-vis advanced markets. So a lot of upside potential there, and there has been some convergence. And certainly, if you look at China, for example, is obviously the standout of the past couple of decades, where living standards have increased rapidly. Before that, Korea and Taiwan have also had quite rapid growth. Brazil, but there's still a lot of growth potential in those markets, and also in areas like Brazil, Russia, and other parts of Asia. Bottom line of all that is that if you can, the demographics plus the scope for a stronger population growth, more growth of that into the working age population, plus lower levels of GDP, so scope for catch up. Just the bottom line is that growth in developing economies has been and should remain stronger than that in advanced economies. So over the past 10 years, growth in developing markets is 5.2% a year, according to the IMF, versus only 2% amongst advanced economies. So more than twice the pace of growth than we've seen in the developed economies. And over the next 5 years, the IMF are projecting growth of 4.9% amongst emerging markets versus only 1.6% in developed markets. So if you look at areas like China, in Europe and Japan in particular, I mean, you're looking at quite sluggish population growth, quite sluggish productivity growth, and so really most of the growth dynamism in the global economy these days is coming from emerging markets. Other features, I mean, the interesting feature also, I mean, going back to that point about there's different blocks within emerging markets. So, a big chunk of emerging markets today is not just commodity exporters, but Asian countries that are heavily involved in technology. So this just shows you how the sector share of emerging markets has evolved even over the past decade. So the share going to energy, for example, has gone from 18% to only 8%. And from materials, which are like mining stocks, going from 15% to 7%. Meanwhile, the exposure in technology has increased from 10% to 15%. A lot more consumer-focused stocks as well, as consumer spending and a rising middle class have been a feature. That share has doubled. So again, when you're investing in emerging markets today, it's not just commodity exposure, but also quite innovative. A lot of up-and-coming consumer stocks, tapping into the strong growth in the middle class, but also the technology exposures, their proficiency in building smartphones, computers, all these sort of things. Fundamentals are also been gradually improving for emerging markets, and I'll just go through a few there. Current account deficit, inflation rates, and net public debt. So, a few years ago, on average, emerging markets used to run trade deficits. Thanks to China, in part, they are now running trade surpluses, and in fact, running trade surpluses, for a time there, higher than that of advanced economies. But certainly, their trade position is in better health than it was, a decade or so ago. Even more important, well, that's important, but even, I guess, more startling has been the change in inflation. So again, a lot of these economies used to be high inflation economies, but they've managed to tackle their inflation problems, and inflation generally still running, somewhat higher than in advanced economies, but nonetheless a lot lower and a lot more stable than we saw, in decades earlier. So relatively low and stable inflation is a good feature. And the other issue is, whereas in advanced economies, public debt to GDP has been rising over the last few years, particularly since the GFC. In emerging markets, they've managed to keep their debt levels reasonably well contained. So that's a very useful, positive as well for these markets. So they managed to keep their fiscal deficits under control and average. So fundamentals gradually have also been improving for these economies. What about valuations? I mean, are the markets grossly overvalued given this growth potential? Well, not really. In fact, if you look at this chart, just looking at relative return performance for emerging markets. Now, I guess this benchmark, the MSCI Emerging Market Benchmark, was launched in the late 1980s, in 1987, and this shows you really performance since then. So you can see that, out of the blocks, emerging markets had quite strong performance. And partly it was the opening up of those markets and a lot of foreign investors getting into those markets. And then we had a period of underperformance when I guess the US technology sector in particular started to take over, and the US market had a very strong period of outperformance. And then emerging markets came back, enjoyed the commodity boom particularly. And if you look at it, they've actually tended to be underperforming in line with the pullback in commodity markets and the growth of the US tech sector over the past decade or so. So there are opportunities there for, maybe the cycle could turn again. And so there is not only, I think, structural long-run outperformance of emerging markets versus advanced economies, but maybe a cyclical turn also toward emerging markets could be upon us. Just looking at the growth, digging into the growth numbers in a bit more detail. So, if you look at the 10-year, over the past 10 years, it's actually lagged somewhat the overall global markets because of that, as I showed from that previous chart. But since 2000, you've got growth of close to 9% across emerging markets, so double that we've seen globally. Valuation-wise, also, I'll talk a little bit about this in a minute, but typically they traded at fairly attractive valuations by advanced economy standards. So price to earnings ratio as at May, only 11.6 versus about 14.3 for the global markets. And price to book, another valuation measure, also less than you see in developed markets. And just to look at that in a bit more detail, of course, emerging markets today historically have tended to trade at cheaper valuations in terms of PE and price to book than you see in developed markets. They are riskier markets, I guess, are less well known, so people demand, better valuations to invest in those markets. But even within that, the markets are actually looking reasonable value. So on a price to book basis, emerging markets at the moment are trading below their long run average. So typically price to book has been at a 20% discount to developed markets, and at the moment it's running closer to 30%. On a PE basis, it's actually close to fair value. It's trading at a discount, but it's close to the sort of long run discount. But another interesting way of looking at valuations is on the following chart also. If you look at price to book, it does trade, so emerging markets do trade at a discount to global markets, but that's despite the fact that the return on equity in emerging markets is quite strong. So it just shows you that there is strong underlying profitability, but because of the risk, generally the risk factors that many investors consider, it does trade at a discount on a price to book. So if you're prepared to look at these markets, there are attractive valuations there. Why active? I guess just to conclude, and really look, you can go passive and you can go active. But if you think about it, it's a bit like why active tends to work amongst small companies as well, because there's a lot of potential diamonds in the rough here. It's a very dynamic, diverse region, less well researched generally than developed markets. So there's a lot of information imperfections out there in the markets that good active managers can exploit. Another feature of it is that if you look at some of the markets around the world in developed, you do see they can be quite top-heavy with some large, typically state-owned enterprises that have a big chunk of the market capitalisation. So if you just went passive and just invested in a market cap index, you're going to basically have to have a big exposure to those lumbering companies, which potentially don't offer that a growth potential than some smaller companies. And just some examples of that, the evidence, the chart shows you there that the correlation in country performance within emerging markets has tended to be lower than that in developed markets. So in developed markets, a lot of countries, a lot of industries tend to move together, they rise and fall together, where there's a lot more differences within emerging markets. So again, that does offer scope for a good active managers to go in there and generate some performance. So really, that is the case for emerging markets, and it's also I think quite a compelling, exciting case, and also the case why we at BetaShares have thought about it and think active does make sense in this market. And with that, we're extending our partnership with Legg Mason. So with that, we'll hand over to Andrew.
Thank you, David, and good afternoon, everyone. I have about 10 or 15 minutes just to quickly highlight to you a little bit about Legg Mason and detail some of the characteristics of our new fund in partnership with BetaShares, EMMG. So very quickly about our organisation. Legg Mason is a global active asset manager. Today we manage around about $1 trillion Aussie dollars of assets globally. And we're organised as a company where we have 9 investment specialist firms which we own, and those 9 investment specialist firms are dedicated to being the best that they can be in their chosen asset class. Locally in Australia, we oversee around about $57 billion on behalf of institutional, wholesale and retail clients. We have a range of unlisted funds in the marketplace, which we're quite well known for, and since the beginning of 2017, we've joined up with BetaShares through our strategic partnership, and as David said at the beginning, or else at the beginning, we've launched 4 funds. This is the 4th fund together. I mentioned that we have 9 investment affiliates that are dedicated to their asset classes. One of those affiliates is a company called Martin Currie, and Martin Currie are the manager of EMMG, the new fund that we're bringing to market today and introducing. So Martin Currie, just a few words of their background. They were founded in 1881. They're a global active equity specialist. They're headquartered in Edinburgh, Scotland, but they have a very big team here in Melbourne, in Australia, who manage a dedicated portfolio of Australian equity exposures. And indeed, 2 of the ETFs we launched initially with BetaShares were focused on equity income solutions, R Inc. and E Inc. But what I'd like to do now is really just focus my time on EMMG. And David, I think, has set the scene for emerging markets very succinctly and clearly. But it is, as he said quite rightly, a market which, and an area that has specific risks that you need to be aware of. And the way that we think about investing in the region, which is our investment philosophy, is we have 4 key beliefs. And they're listed in front of you, but I will just spend a second or 2 in each of them. First of all, the market frequently misprices companies' long-term value creation potential. Particularly in emerging markets, we think this is true. To David's point, these markets tend to be under-researched, and they can be moved around quite significantly by capital flows both in and out. We are very focused on doing the groundwork and identifying those companies through fundamental company research. That means we travel extensively across those 26 countries and 5 continents that David referenced at the beginning to meet with companies, but not only companies. We want to meet across the supply chain. We want to meet regulators, governments and central banks to really understand what's driving the economies and the companies within that on a case-by-case basis. We focus, from a philosophical point of view, we believe that sustainability risks have a direct impact to the long-term return potential of a company. And I'll come back to that, but that's really thinking about non-financial factors in our analysis and ensuring that we embrace economic, environmental, social and governance factors in what can drive returns both positively and negatively in the companies in which we invest. And finally, a very strong belief in high conviction portfolios. As David mentioned, there are 1,100 companies in the index. What we do is we find the 40 to 60 best companies in our assessment and put them together in a portfolio. And in every company we review, we look at them through 3 different lenses. One around the quality of that company. So how strong is that company in its sector and in its market? What is the growth potential both in the short term, but more importantly over the medium to long term. And then finally, what price do we have to pay to access that return potential? And we have a strong valuation discipline to make sure we're buying the best companies with the best outlooks at the best price. So who does that for us? As I mentioned, Martin Currie are headquartered in Edinburgh. There's a team of 7 dedicated portfolio managers and analysts who are focused on the emerging markets. And they manage one strategy, they manage one product, they manage one approach, and they are one team. And EMMG is giving you exposure to that very same portfolio as we would offer to the biggest institutional investors around the world. And that's what's available today. In terms of the team, you can see on the list of names on the right-hand side their years' experience in the market as investors. I would highlight 2 names on that list, Alistair Reynolds and Kim Katekis. They've actually partnered together for almost 20 years. They developed this strategy that's been successful over that period of time and have built the resources around them. And the team today has 136 years experience collectively. So David, just as he passed over, highlighted why active is important in emerging markets. And we couldn't agree more. If you look at the index, as David referenced, there can be some big dominant positions in the indices, which are basically companies which can be partly state-owned and can have a different agenda than necessarily driving return outcomes for shareholders. So EMMG is a high conviction portfolio of our best ideas. And what I would highlight here, a couple of points. Under sector and country limits, you will see that we have no sector and country limits. We are free to search across the index and across the markets to find the very best ideas and companies, regardless of country or sector or size. The number of securities is 40 to 60. So we're buying securities that we have strong conviction and belief in. And if we don't like a security or a company, we will not hold it in the portfolio, regardless of its size. And then you'll note the portfolio turnover. What that means is how much of the portfolio changes in a calendar year. You'll note that some managers, they might turn over portfolios quite quickly. To us, that's more of a trading mindset. What we're trying to do is identify the long-term winners. And we, in our analysis, focus on 5 years plus in terms of our return expectations. And that means we tend to hold companies for a longer period of time to let good ideas compound up and generate the best returns for our investors and shareholders. The next slide just talks a little bit about the investment process. I don't intend to dwell on this, but what we look at across emerging markets, there are 1,100 companies in the index, but we actually look at about 3,000 different companies that are investable from our perspective. We then drill down through that list of companies and we're looking for the best ideas, be that on a sectorial basis, a country basis, or a stock basis. And from that, we organize our research agenda and build out a short list of what we call our approved research list. These are companies that we have done extensive, detailed work on, both from the 3 different lenses that I mentioned, across quality, across the sustainability of future return potential and valuation. And these are companies that we'd be very happy owning today. And this list is consistently and constantly being reviewed and refreshed. From there, the management team then select the 40 to 60 best ideas across that group and construct that into a portfolio. What we want to do is identify the companies that we believe will win, will drive the best returns, and our focus is very much on identifying the best companies than necessarily calling which country will do better versus another country. So it's very much about a stock selection process and identifying the long-term winners. We would also, in every instance, meet and continue to engage with every company that we invest in. In terms of how we do that fundamental research, there's really 3 elements. The first element is our financial work. And really what makes us different is we have a very long lens. So we build out long-term financial models and expectations on a company's return over the medium to long term. We're very focused on cash flow. We believe that cash is a much better predictor of future than profit. There's a lot can go on in the balance sheet of a company between the cash at the top line and the profit at the bottom line. And in every company we invest in, we build out scenario analysis. What is our base case expectation, but what is the upside from that, but also what is the downside risk? And we ensure that we are thinking through what could go wrong as well as what could go right. The middle box is more about the non-financial factors, so particularly around environmental, social and governance factors. That's heavily embedded into the core of our investment process. Martin Currie are a signatory to the United Nations sponsored Principles of Responsible Investment, and indeed they have the highest ranking for their embedding of the ESG analysis into stock selection, and they're rated A+ across the three main characteristics of that UN-sponsored body, which is the ESG strategy, the integration in the investment process, and importantly, as active owners. And as active owners, that means significant engagement with our investee companies to continue to drive long-term sustainable returns and impact on economies going forward. Lastly, and importantly, we factor in top-down risks. As David showed on his slides, there's quite a big dispersion of returns between different emerging market countries. And that's not really a surprise if you look at the map that he showed earlier. You have countries in different parts of the world with different drivers, different economic cycles, and they behave in different ways. They also have social risks and geopolitical risks that we need to be aware of. So all of those different things are factored into our research process. We see those as risk factors, not necessarily things that we're trying to maximize returns off, but very much embedded into the stock selection. From there, we then publish our investment idea, which goes onto that research list, which I referenced before. And then from there, we pick our very best ideas for the portfolio. I talked about this a little bit in the last slide. So what I would say is to add to that is we look at all of these different top-down elements in our process. We also share our thinking in this area, and we quite often will publish a white paper written and authored by the fund management team about different drivers that are happening today and what we think the impact could be going forward. And as an example of that, we've recently published a white paper around the trade wars between the US and China and the impacts that that can have on emerging markets. So something that we share with our investors and something that BetaShares and Legg Mason will make available to investors in this strategy going forward. So having done all of that work, just to talk about the portfolio, so the metrics on the right-hand side just reflect the characteristics of the type of companies that we're trying to buy on an individual basis. And I'll pick just a couple of statistics out here. You'll see on the quality side, we have a higher return on equity for the companies in our portfolio than you get if you buy the index. So we would expect a higher return on the equity deployed by those companies over time. We also have higher dividend cover and higher interest cover. But the other one I think is an important stat, and again, David referenced the debt of the different developed markets versus emerging markets. Well, you can see the debt to equity ratio for emerging markets is already lower than developed markets. But in our portfolio, it's lower again. And what that's telling you is our portfolio has higher quality companies. They're more cash generative, they're using less leverage, and they're really in control of their own destiny because they're able to generate cash to reinvest in their operations and to continue to grow their business. And if we drop to growth, looking backwards, we can see that the portfolio has generated much higher earnings growth, 15.7 versus 8.9 for the index. And then forecast, our portfolio is forecast to have higher earnings growth again than the index, 15 versus 12.4. So again, we have a high growth, high quality portfolio. It's around about market value, a little bit more expensive than the market on a couple of those measures. But we have a portfolio which reflects very much the investment philosophy that is our guiding principles that we ensure that we follow in all of our stock selection. Just a slide that David has shown, and just previously. But we think if you look at the developed markets versus the emerging markets on the right-hand side, we're now at the point where developed markets or developing markets, emerging markets, have caught up on the return on equity. So that's really telling you that management and the companies in the indices are well run and are starting to really generate returns for shareholders. And they've come from a long way back if you look to what those numbers look like in 2009, 10 and 2010. The other side of the equation is the price to book, which is one metric of value. There are many, and I agree with David that emerging markets are riskier, so you can expect some more volatility. But there's a significant discount on a price to book basis on the emerging markets versus the developed markets. And they were actually in line with each other just 7, 8, 9, 10 years ago. Obviously, developed markets have had a very strong run, driven heavily by the US market and the technology part of that market. So there's definitely room for that gap to narrow, creating some opportunity for emerging market returns, we believe, in the near to medium term. So maybe just to finish, this is also a new fund. EMMG is a new vehicle which we've launched with BetaShares. We do have an unlisted version of the fund, so we have a track record that we can show you for Australian-based investors. And the table shows the 1 year, 3 year, and 5 year returns after all fees and charges and costs. And you can see on the 5 year, a significant outperformance of the benchmark, about 1.5% per annum. As the average return, and over 3 years that number has been better, again still at 2.97%. The unlisted fund was launched in 2011, so has a long track record on which to base those statistics, and it's also followed by the independent research houses such as Lonsec and Zenith. Finally, just to close, and I'll pass back to Elle, EMMG gives you access to the world's fastest growing economies in one single trade. What we do at Legg Mason and with our affiliate manager, Martin Currie, is we're building an active portfolio of our best ideas. I said the range is 40 to 60 stocks today. It's actually 47 holdings that you would be investing in. The total management costs are 1% per annum and capped, so you know exactly the costs. And it's based on that proven track record of the fund that I just shared in the previous slide. We're very proud of our partnership with BetaShares. They bring to us a huge amount of skill and insight in the ETF marketplace that we do not have, but we bring to them active management capabilities and access to expertise that they do not have. And we think that that creates a very powerful partnership, and we're proud of what we've built with them over the last 18 months, and we look forward to developing our relationship with them going forward. And EMMG went live on the exchange on the 29th of May, so we're up and running and it's accessible today. And with that, I'll pass back to Elle.
Thank you so much, Andy and Dave, and everyone on the line. Before we pass over and answer a few questions that have come through, just a few final items to please keep in mind, and that's that all investments do come with risks. So returns are uncertain and are always influenced by fluctuations in the market. Always seek professional advice before making an investment. Any performance is never an indication of future performance. And please once again refer to any PDF documents for information on investment risks. So we've had some questions come through that we'll pass through to either Andy or Dave. For those still on the line. So kicking off, Dave, this one is for you. You mentioned the capability of financial markets was a key issue for investments. What about the transparency and governance issues?
Well, that's yeah, I mean, obviously, as Andy mentioned, these are factors. I mean, some areas, governance and transparency may not be as good as you see in developed markets. But, you know, with that, there can be opportunities, you know, it's risk and return. But there are, you know, there are some screens that you know, you can put in place and ensure that there's a minimum level of you know, good governance standards. I mean, as mentioned, you know, the funding that we're talking about today does screen companies for these sort of things. And in fact, I might just pass to Andy to talk a little bit more about about the those type of screens and the in this area.
Great. Just to add to that, then a couple of things from our perspective. We are very much active managers, and that means to us that we have to see the companies, meet the companies, both on the ground in their own territory, and we get a lot of visits to our offices, and the emerging markets team are based in Edinburgh, so they do that. That'd be one point. Secondly, the team are actually proficient in, I think it might be 9 different languages, so they're able to read local news flow, converse with companies in their local language. That's an important element, and actually they sit beside a very well-resourced Asian equity team who also bring language skills and stock knowledge into particularly the Asian markets, where it's important that we look at that. Governance is incredibly important to Martin Currie as an organisation. So they assess companies' transparency, they assess their governance, and we need to be able to see and access the information that we need in the format that we need it. And we will and we do as an organisation actively vote on our stock if we hold it, and if we feel companies are behaving in a way that we are not comfortable with, we will be active in an engagement sense. So we will get involved with shareholder meetings and shareholder votes. And ultimately, if we're not comfortable, the ultimate sanction is to withdraw the investment from that company and move on. And there are plenty of opportunities out there. So very dear to the investment process, very central. It is one of the biggest single risks, and it's therefore something that we spend a disproportionate amount of time on, making sure we understand the company's view of the shareholder and the ability to get the information in the way that we need it.
I'd just make just a follow-up point there. I mean, this I think is a classic case where active management and boots on the ground do matter, because the level of regulation and oversight in different countries and obviously area, and more specifically actual firm level governance can be somewhat more variable in emerging markets, I think, than developed markets. Within developed markets, is more of most of them you can expect companies to be following all legal precedents and have fairly good regulations in place, whereas it's a bit more uneven in emerging markets. So yeah, boots on the ground do matter, particularly so as a result.
Thank you, Dave and Andy. Dave, another one for you, something that I think is on everyone's mind often. Where do you personally see the markets trending over the next 3 to 5 years?
Look, from a big picture point of view, obviously we're 10 years into a global bull market. So from a purely historical point of view, it's looking quite long in the tooth. We are going to probably, get some pullbacks as a result. But I mean, through that. But I mean, at this stage, there's no the outlook I think is still quite encouraging. I mean, bull markets and global expansions don't necessarily die of old age. You do need something to come along to generate that, to sort of knock them off their heels, be it, inflation, be it some sort of credit event. But the reality is global inflation at the moment still remains quite well contained. And so much so that central banks are now changing their tune and cutting interest rates. I mean, the Federal Reserve overnight provided a pretty big hint that it's going to cut rates, if not next month, then at the next meeting. So, the outlook, I think, is still pretty encouraging. And, 5 years out, that's another issue. We'll see what happens. But, I mean, I certainly think for the foreseeable future, it's a time for engagement in the markets. And just going back to emerging markets specifically, as you can see the cycles in relative performance, if it's true that the US is hitting closer to its, it's had a very strong run. If the Fed is now cutting rates and the US dollar is going to be softer, in fact neutral, typically the emerging markets can do pretty well in a soft US dollar environment. So I think there's good potential for a turn in the cycle that could favour emerging markets over the next few years.
Excellent, thank you. just mindful of time, we will wrap it up there. But a reminder that the recording and slides will be sent to everyone online and who is registered today. And thank you all once again for attending.